We specialise in protecting, preserving and growing your wealth. Blacktower Financial Management, the team you want by your side. Visit blacktowerfm.com.
Talking to Christina Brady from Blacktower Financial Management, where we've had a look at the market, see what's going on now. We touched on pensions and maybe people having to save for the future because there might not be a state pension in decades' time. But here's something I stumbled across because occasionally, I know it doesn't sound like it, but I do a bit of prep for this about people not saving enough and just not really understanding about how to get started with investments. This is out of the UK. 4 in 10 Brits basically have no idea how to invest for the future, and I think part of it is they think it's just for the very wealthy that have got money to invest, hundreds of thousands of pounds. Where do you start? Can you offer an insight into this?
Actually, yeah, I think it's more than 4 than 10 don't have any idea. My daughter and her boyfriend were asking about investing the other day, and that's why I said I think schools fall really, really short on educating youngsters nowadays. They don't concentrate on real life, and there should actually be a class on, finance and how you open a bank account, how you invest, how you can do these sort of things. And I do go around various schools in the Costa Blanca and give talks on this. And both children and parents find it very, very good. And it encourages the children who are obviously going to go to university, etc., to think about money and how they can make money. It's, the younger you start, the better. It's easier said than done because when you're young, you want to buy things. You need a car, you're trying to get a house. It's very difficult to save. But if you can, the younger you start, the better. But I think what you need to do is, first of all, no matter what age you are, you need to sit down and you need to decide what your goals are. Be realistic. If you've got a lump sum, if you inherited a lump sum, if you managed to save a lump sum, if you sold a car, you've got a lump sum, however you've got some, or if you're just saving a little bit, what do you want that money to do for you? But be realistic. Most people go for what we call passive investing. So they pass their investing on to a financial advisor, or they will just invest in what we call passive funds. So funds that follow an indices like the S&P 500, the FTSE, etc., because they haven't got the time, the knowledge, and it does take a lot of effort into doing this. And if you do it full time, as I do, obviously over the years you get more and more knowledge. You understand which fund managers are good, etc. A good way to start is, once you've realised what your goals are, and to be realistic, is how much do you want to invest? How much have you got that you could put aside, or how much can you save each month? And and on top of that, obviously, things change as you get older, so you have to revise these goals as you get older, because what you want when you're 20 is completely different to what you want at 40, or what you want at 60, or what you want at 70. Things do change in line with your life, and work out what risk you are. Most risk scales go from 1 to 7, 1 being the least risky, 7 being the most risky. And obviously, you've got safest is no risk. So that's having a bank account, deposit account with a bank that's guaranteed by the government. As you know, the UK's got the guarantee up to 85,000, and in Europe it's 100,000 euros, and in the US it's $125,000. But that's only if it's in a straightforward current or deposit account, not if it's invested in any form of investment. Nice. So if you're in Spain, the banks offer you things called fondos. They're not guaranteed by this at all. So once you've decided on your risk, then you need to look at the different ways to invest. So there are lots of different ways you can invest. You can go and you can look at buying shares yourself. You can go onto a share platform, a trading platform, and buy some shares if you think a certain company is good. You don't have to put a lot of money in. You can always put money in a fixed term deposit, which you can get through various banks. You could put your money in a government bond. They're the safest places to go, but usually they have the lowest return. However, if the markets are volatile, or there isn't much of a return as there is at the moment in the markets now, sometimes they do actually give you a good rate of return. At the moment on sterling, if you put it in for a year, you can get 5.3% or just above. Euros is less. Euros is just under 3%. So, you can put that in there, and you can put that in for 12 months or 3 years or whatever you want. And usually the capital is guaranteed, and you get that growth each year that you keep it in. If it's 1 year, obviously the rate's revised after each year. If it's 3 years, it's fixed for that term. So you just have to decide what type of investment you want. If you want the potential to make more, then obviously you go into stocks and shares, or you go into buying funds. Why do people buy funds? Because they're managed by qualified people, usually fund managers who have a team of analysts who look at everything that goes into that fund, and based on statistical data and historical data and projections, they try and work out where's the best to place your money, which countries, which sectors, etc., etc. And they have their day and their time is dedicated to doing this. And there are some very, very good funds out there. I would usually use, if I do an investment portfolio, I look for funds that have got a good track record, 10 years or more. And obviously I look at the risk factor as well and various other things. However, you have to remember, if you've been investing for a while, maybe 2 or 3 years, last year was a very, very bad year for investments. I think 95% or more of funds didn't make money, and some of them lost 20, 30, 40%. This year, there have been slow gains, but obviously it's not making up for last year yet. No. And I think this year is going to be not so volatile. I think there's not going to be that many gains. There could be a slight downturn. I think people are waiting on what happens in UK elections. What happens in the US is very relevant. What's happening in China at the moment as well weighs lots on the markets. There's lots of things affecting the markets at the moment. So you've got various things. You've got the safest, which is deposits, government guaranteed bonds. Next, you've got money market accounts. You've got treasury notes, etc. Then you've got low risk investment portfolios, which are a 3, and then after that you go to more balanced stuff where you're investing in funds. Now, if you want to go high risk, you've got to accept you can make lots of money, but you could lose a lot as well. And high risk is considered high yield bonds. So in countries that haven't got a very good government structure that could default, leveraged products, derivatives, IPOs, and alternative investments. And all I can say when you look at investing is be realistic. So keep it real. Yeah. And remember, no one size fits all, answers everybody. So it's the same with financial advisors. If you go see a financial advisor and they've only got one solution and they're trying to tailor that to meet everybody's needs, that is not correct. At Blacktower, we've got access to the whole of the market. And we can give you anything, well, within reason, we can give you anything that we think is suitable for you. Hopefully, we try and keep it tax compliant in Spain because there are benefits, but sometimes it's worth going outside that to get a good return on your money. And also, please, this is something I say every single time. If something sounds too good to be true, it usually is. Okay, if everyone else is offering you a return when capital's guaranteed of, say, 5%, and you get an advert for, or you see a website saying your capital's guaranteed on sterling will give you 10, 15% a year, that is a con. Okay, that is not possible when interest rates are that low. It's still, relatively low. We're not seeing interest rates of 10, 15%. So be very, very careful, because also, investing, sometimes people can get taken in by greed. Okay, they read stories in the paper of people making a lot of money doing this sort of investing. Same with cryptocurrency. If you got in there at the beginning, you've made a lot of money. If you're going in now, you may not make so much money because the markets, go up and down quite drastically, as you know, Moody.
Yes, well, that's just my little dabble. It's quite a good introduction to it, I think, if you can just put in what you can afford to lose.
Yes, exactly.
You just watch how it works and see how it goes up and down and just kind of get used to that. It might set you for the future.
As I said to my daughter, I said the younger generation, if they want to get into investing, they're on platforms, and if they see a product or an idea that seems to be taking off, maybe put something into the stocks and shares of that company. Not a lot, but, Instagram, if you'd got in at the beginning, these sort of things, they're at the cutting edge of technology, most youngsters, because they're on their phones 24/7, sadly, and they've forgotten how to communicate and how to live. But, they may see things on there like a fashion brand that's coming up, or I don't know, a car brand or something, and it's worthwhile then doing some research into it. And it's quite a challenging thing to do, but it can be quite interesting, and seeing if it's worthwhile investing. And as I said, you don't have to put a lot of money in. People who made money out of Apple, out of Microsoft, out of all these companies, they were startup companies at one time, and people put money in. And if you invest in, say, 10 startup companies, maybe only one will actually make it to the big time, but if you're in that one, you're very lucky.
Yes. A couple of people.
So you've got to do.
Microsoft folk that are behind that. We don't know their names, but living in a solid gold house somewhere, probably in Hawaii.
You have to take risk, and people who say they don't want to take any risk really are never going to have the potential to make a lot of money. You take a risk every day getting out of bed. You take a risk getting in your car every day. You take a risk walking down the street every day. You may not think you do, but you are. You've got to then sort of equate that risk to what you would allow with your money. Okay?
Yeah.
And it's difficult, I know, but most people now are familiar with risk. And the main thing is never put all your eggs in one basket. I had a chap in yesterday who sadly was convinced by his bank many years ago to invest his money in a investment that was purely linked to the performance of banks. And this was just before we had the Lehman's crash. Okay, and the bank, which will remain nameless, was a very large bank. The person in the bank, because they've given products to sell, they don't really understand most of the underlying, said, oh yeah, it's a good bet, you invest in these big banks. And then suddenly the banking bubble burst, and he lost a huge amount of his money. Now, if he'd been diversified across sectors, he would have lost some money, but not all of his money. And I think that's another thing to keep in mind when you do go into investing, diversify. And if you're can't do that yourself, then look at a fund or a portfolio, because they usually, it depends on what you're looking at. Portfolios are very, very diversified, usually across sectors, across countries, across risk. And you have portfolios like a cautious, balanced, you've got cautious balanced, you've got balanced growth, you've got various different portfolios you can go into. You don't have to put all your money in one, you can split it between a number of them. And that way it gives you some comfort as well. And I think, to dabble in investing is fine, but unless you've got a lot of time on your hands and you're prepared to do the work to get the knowledge, it is very difficult to manage investments solely on yourself, by yourself.
Presumably,
and that's where sometimes you need to get professional help. Yeah,
so if you've got a fund under a fund manager, are there options to sort of completely hand it over to them, or you're able to pipe up occasionally and say, well, I'm quite interested in this, what do you think? And then take it on board?
Usually, if you're going to go into a fund, you can buy some funds direct, but usually what you do is you buy them within a portfolio. So what you'll have what's called like a wrapper or a bond, and in that you put your investments. So someone will say 50,000, will say, right, I want to invest in water, robotics, I don't know, UK equities, S&P tracker. And what you do is you put together a portfolio that has all those funds in it, and then you go through it with the investor and you talk them through how each fund's performed historically, where they are now. And what you have to remember is, though historical performance is a good indicator of the way they perform, it is not a guarantee of the way they're going to perform going forward. So you have to obviously look at that. And if it looks very good, sometimes I have funds and they've made 10-15% a year, and we're talking sort of 2021, and I said to people, right, that's what they're saying, but let's realistically say they're going to make 5% a year. So bring your expectations in line with reality, and then if you make more, you'll be happy. But understand that funds go down as well as up. And I think up until we had COVID, most of it was steadily growing. You didn't have that many downturns since 2007, 2008. And people were used to seeing steady growth on their portfolios, on their investments. That has changed dramatically since the lockdowns, since we had the one crash in March 2020, and we've had other things that have had a knock-on effect since then. Conflict in Ukraine, Russia, political unrest, etc. So, as I said, you've just got to understand that you are not going to make money all the time, but investing is not, unless you're going to trade daily, it's not for short-term gain, it's for medium to long-term gain. So you're looking 5 years plus, and if you're younger, 10, 20, 30 years. And that's the whole idea of investing. is to watch your money. It can go down as well as up, but it will grow gradually over time. And if you look statistically back across time and how, various indices and various funds have performed, even with the downturn, they've still made a huge return on your money.
Yeah, this survey I was pulling this from, it said 47%, so almost half, they said they're daunted by the prospect of just getting started. But I'm betting that there are some that once they do get started, they get right into it and have to be reined in a bit sometimes, probably.
I think you could get hooked, actually.
Yeah.
It depends on your,
as long as
your
you've got
personality.
someone there to keep an eye on you, a proper, as a qualified person, might be an idea.
It is difficult because, once you start making money, it's like betting, isn't it? Once you win a bet, you think you're always going to win. Absolutely. But you've got to understand there will be downturns. And I think most people do. However, if you've got an addictive personality, and I would be very, very careful, and I'd most probably hand over that to someone else. And if you are exceptionally risk adverse, then you need to go for something that's going to give you a low rate of return but is capital guaranteed. And when people do investments nowadays, you can have online access to your investments. Yeah. And I find the most worrying people are those that check every day. So one day you'll get an email saying, oh my God, it's brilliant, I'm up 5%. Then like a week later, oh my God, I'm so depressed, I'm down 2% or I'm down 10%. That's not what, long-term investing is for. No. That is like being a spot trader for foreign exchange. You go in each day and you hope to make money rather than lose money. As I said, investing is hopefully you will have downturns, but in the long term, the good times will outweigh the bad. And I think that's what people do realise nowadays. Usually when there's a downturn, very, very few people panic. If there is a downturn and you sell, you're crystallising a loss. If you wait it out, it will come back, and therefore you can either sell at the same price you went in or wait till you make a profit. And I think that's when you need a steady nerve and, to be able to talk to your financial advisor. I had someone send me an email on Friday. They were worried that one of their portfolios had gone down. So we went through and we analysed each sector, each fund, and at the end of it, they understood exactly where they were, and they were more than happy to leave it where it was. And I think you need sometimes to have someone to bounce this off and to make you feel more comfortable. And if things are going wrong, we don't always get it right. I have to admit, there were some funds that were doing remarkably well in the, 21, 22. I think one company, Ballygifford, springs to mind, and some of their funds have done abysmally since then. And sometimes you have to admit a mistake, cut your losses, and then invest in something that's going to make that money back for you.
Yeah, that's another problem doing it yourself as well, because time flies so quickly. A couple of years later, and you just think, well, that's a great stock to have, but things do change, and you just still think of it as being, a high performing one.
Yeah, like at the moment, people who want to take less risk, we can move them into money market funds because interest rates are higher than they have been. Money market funds can give you 3-4% per annum. But as soon as interest rates start to fall, you have to be prepared to switch out of those because you're not going to be making any money anymore. So it's very important to understand where the markets are, how, different factors affect the markets and what you need to be doing at certain times to try and minimise your risk and to try and, if you can, get as much upside as possible. But at the moment, as I said, it's still trying to claw back what was lost last year for most people. If they've only been invested for a short time, if you've been invested for a longer term, you're not that much down. But if you just sort of came in 2021, you could be down a little bit, but that will come back. And as I said to people, you just need to hold your nerve. Investors love it when people sell when the market's going down because they've got surplus cash, the wealthy, and they will go in and buy everything that you're selling. And that's how they become more and more wealthy because they know people will panic, they know people will sell, and they rub their hands and think, hey, here we go, let's buy this really cheap.
Yeah, so just for, finally, the final stat I'll pull from this, 49%, so again, almost half. They just kind of put off making any investments by the idea that only the wealthy can do so. It's only for the well-off to do. So you'd say that's not necessarily true. That
is a load of balderdash. I'm allowed to say that word because it's not his word. It's not a word. I can say balderdash. It is absolutely, you can start investing in shares with £5. You don't need huge amounts of money. Investments we do, okay, we can start from 25,000 usually. And obviously we weigh up the benefits of doing that. But there are some good investments out there that you can start with 25,000 and then you can build from there. As I said, you can go into shares with not much money at all. So no, it's not only for the wealthy. And I think that's how the wealthy are wealthy, because they have invested. And if you look at most wealthy people, they admit that they've made mistakes, they've lost money. Most of them have become bankrupt at one time or nearly bankrupt, but they've always held fast and believed in what they're doing. And I think that's what people need to do. You need to take that leap of faith. You need to put some money in. As I said, don't put all your money in. Always keep back a contingency fund and just invest what you are comfortable with having some form of risk on. And make sure that you're whoever you invest with, or if you do it yourself, you understand the risks involved. And don't ever be rushed into anything. If someone sends you something and says, look, this is the rate of return, you've got to invest this week, you've got to do it now, step away. Don't do it. Never do anything in haste, okay? Always think about it. Don't procrastinate for years and years, but obviously take your time. And that's what I have to say as well.
That was great. I mean, I thought that was worth doing, and I just put it to you just before we came on, but I had full confidence you'd be able to answer it just as perfectly as you have done. So that was a great bit. Thank you for that.
No, thank you for bringing it up, because obviously sometimes the markets are a bit sort of at the moment, and so it's good for you to bring up a topic to talk about. And if anyone hasn't got any topics you want us to cover, if you just let BayRadio know, they will let me know, and I can always add it into one of the programs for you.
Absolutely, usual methods to get in touch here. WhatsApp 684 455 844, studio at bayradio.fm. Almost out of time. If anything's come up that you might want to talk to someone like Christina about, easy to get in touch. Many ways to get in touch with Blacktower Financial Management.
Yes, you can email info@blacktowerfm, all one word.com. Put for the attention of Christina, I'll put BayRadio, it will come through to me. You can go to our website, which is blacktowerfm.com. If you look under locations, you'll find Costa Blanca. You can find my details. You can go on the BayRadio website under advertisers. If you click on Blacktower, it goes through to our website. You can always Google Blacktower and find the number. The number for the office is 965058212. And remember, we don't just cover the Costa Blanca. We cover the whole of Spain. We cover most of Europe. We've got offices in North America, Middle East, Australia, UK. And from the last show, we had someone contact us from the US, and someone from the UK, and someone from France.
Oh, wow.
So and I just hand you over to, and actually someone who was interested in Portugal. So I just hand you over to the appropriate person in that area, and they will get in touch with you, and they will help you and make sure that whatever you need, they can hopefully help you with.
Listening and exceeding expectations for over 31 years. Blacktower Financial Management, the team you want by your side. Visit blacktowerfm.com.